buy-to-let is dead. Or at least, that's what everyone keeps shouting from the rooftops. Scroll through landlord forums and you'll see panic. Open the newspapers and you'll see headlines declaring the end of the rental property era. And on TikTok and YouTube, content creators are telling millions of viewers that buy-to-let investing has officially flatlined. But here's the question: is it actually dead? Or is this just the beginning of a new chapter? Because while thousands of landlords are throwing in the towel, others are quietly pocketing bigger profits than ever before. The rules of the game have changed. The easy money has gone, and unless you adapt, you're going to get left behind. So today, we're lifting the lid on what's really happening. We'll break down the biggest challenges landlords face right now, from brutal tax changes and tough mortgage stress tests, to controversial legislation and shifting tenant rights. But we'll also look at the hidden opportunities, the strategies the savviest investors are using to not just survive, but thrive in 2025 and beyond. Stick with me until the end, because I'm going to reveal why the phrase buy-to-let is dead might just be the biggest lie in property right now, and how it's quietly creating the biggest transfer of wealth we've seen in decades. So let's start with this so-called death of buy-to-let. What people really mean when they say it's dead is this: it's not as easy as it once was. Back in the 90s and early 2000s, buy-to-let was almost a cheat code. You'd put down a deposit, buy a semi-detached in an average town, rent it out, and within months you'd be cash flowing. Rents went up, property values went up, and it felt like free money. In fact, whole generations built wealth this way. They weren't necessarily skilled investors either. They were just in the right place at the right time. But times have changed. We've had new tax rules, new lending restrictions, and new regulations around tenant rights. Mortgage rates that once hovered around 2% are now back up in the 5–6% range. Tenants have more power than ever, while landlords have more costs than ever. And this shift has created chaos. Some landlords are panicking, some are selling, some are warning newcomers to stay away entirely. But here's the thing nobody tells you. Property investment hasn't disappeared. People still need homes. Demand is still through the roof. And where demand exists, opportunity always follows. That's why I don't believe buy-to-let is dead. I believe it's evolving. The old strategies don't work anymore. But new strategies, they're working better than ever. And if you stick with me, I'll show you why. But first, let's look at the biggest barrier stopping people from even entering the game. The first real challenge is getting in at all. The phrase vanilla buy-to-let describes the simplest approach. Save up a deposit, buy a property, and let it out. Easy. But right now, vanilla is basically extinct. Why? Because the entry costs have gone through the roof. Take London. Average house prices there sit around £600,000. A buy-to-let mortgage usually requires a 25% deposit. That's £150,000 up front. Add in stamp duty, which is even higher for second homes, plus legal fees, plus a refurb if the property needs it, and suddenly you're well over £200,000 before you've even got the keys. And this isn't just a London problem. Across the UK, even in areas like Manchester, Birmingham, or Bristol, deposits alone can stretch into the tens of thousands. That's before you consider stamp duty surcharges, an extra 3% for buy-to-lets that eat into your starting budget. For a first-time investor, these numbers are daunting. Many don't even get past the spreadsheet stage. And here's the kicker. Even if you somehow scrape together the deposit, your problems aren't over. Because the bank might still say no. That's right, the deposit isn't enough anymore. You've got to prove that the rental income covers not just the mortgage now, but potential increases in the future. And with interest rates higher, those stress tests are harder than ever to pass. This is where people feel the game is rigged. They say, I can clearly afford this property, the rent covers the mortgage and more, so why won't the bank approve me? The answer lies in something most new investors don't even know about: stress testing. And that brings us to the next big challenge. Let's talk about mortgages, because this is where a lot of landlords are feeling the squeeze. For nearly a decade after the 2008 financial crash, landlords lived in paradise. Interest rates dropped to record lows, often between 1–2%. That meant borrowing was insanely cheap. Investors could refinance existing properties, pull out equity, and use it to buy more. Portfolios exploded in size, but those golden years made people complacent. Many landlords thought it would last forever. They built business models around ultra-low rates. And then came the wake-up call. Today, mortgage rates are back around 4.56%. On the face of it, that's not catastrophic. In fact, if you zoom out, the average UK base rate over the last 50 years has been around 9%. Older investors will even remember the nightmare of 17% rates in the late 80s. But here's the difference. The entire buy-to-let sector became addicted to cheap money. When rates rose, even slightly, the entire system felt the shockwaves. And it's not just the rates, it's the affordability tests that come with them. Here's how it works. Lenders don't just check if your rent covers the mortgage, they demand a safety buffer, often requiring your rental income to be 125% or even 145% of the mortgage. So if your rent is £1,250 per month, your mortgage can't be more than £1,000. If rates push your mortgage higher than that, suddenly the deal fails the stress test. This is why so many landlords are being turned away, even when, on paper, they could afford it. And this is where the frustration boils over. Because the average investor thinks, if I can cover the mortgage with rent, what's the problem? But the bank doesn't care about today, they care about protecting themselves tomorrow. That's why so many deals that used to work no longer do. But don't worry, this isn't the end of the story. Because while vanilla single lets struggle to pass, other strategies pass easily. And we'll come to those. But first, let's look at the most feared change of all, the legislation war. If higher costs weren't enough, landlords are now staring down the barrel of new laws. The biggest headline? The government's promise to abolish Section 21. Section 21, also known as no-fault eviction, has been a landlord's safety net for decades. It meant that, after a tenancy ended, you could take back your property without needing to prove tenant wrongdoing. Without it, landlords fear being trapped. Imagine a nightmare tenant, paying late, damaging the property, causing stress. Without Section 21, you'd have to go through lengthy legal battles to reclaim your house. That's why forums are exploding with panic. Some landlords are saying, "That's it, I'm done." They believe this is the nail in the coffin. But here's the truth. Section 8 still exists. That allows you to evict tenants who break their agreement, whether through rent arrears, antisocial behaviour, or other breaches. It's harder, yes, but not impossible. And whispers suggest there may even be exemptions for smaller landlords with under 5 properties. The government knows if too many leave, the rental crisis only worsens. So is it inconvenient? Absolutely. But is it the end of buy-to-let? No. What it really shows is how fragile landlord confidence has become. Because when fear spreads, people panic sell. And when people panic sell, opportunity opens up for those who keep their nerve. But legislation isn't the only sting. Taxation has been just as brutal. And it's here that some landlords really felt their profits vanish. If you ask older landlords what hurt them the most in the last decade, they'll probably say one thing: Section 24. This tax change flipped the entire sector on its head. Before it, landlords could offset mortgage interest as an expense. That meant if you earned £10,000 in rent and paid £7,000 in mortgage interest, you only paid tax on the remaining £3,000. After Section 24, you're taxed as if the full £10,000 was profit, even though £7,000 went straight to the bank. This created something called phantom profit. On paper, you looked rich. In reality, you were broke. I've personally seen landlords go from £10K a month net to £10K a year. Some even worse. This is why more and more investors now buy through limited companies. In fact, 60% of new property purchases are structured this way. Inside a company, mortgage interest is still deductible. But what about the landlords already holding properties in their personal name? They're stuck. Many have been forced to sell. Others are clinging on, hoping things change. The lesson here is brutal but clear. The government isn't finished targeting landlords. If you want to stay in the game, you've got to structure smart. And that brings us to the exciting part. The alternatives. The strategies that not only survive these challenges, but thrive in them. This is where the new game begins. Traditional single lets, the bread and butter of old-school landlords, are struggling. But alternative strategies, they're booming. Take HMOs, for example, houses in multiple occupation. Instead of one tenant paying one rent, you've got 5 or 6 tenants paying separately. Suddenly, that £1,000 mortgage is covered several times over. Banks love it. Yields are higher. Stress tests pass with ease. Then there's serviced accommodation, Airbnb-style rentals, tourists, business travellers, even NHS workers. Done right, these properties can generate 2 to 4 times the income of a normal rental. Risky? Yes, you need to understand occupancy rates, seasonality and regulations. But the rewards are huge, and don't overlook commercial property. Shops, offices, warehouses, they come with higher yields, longer leases, and tenants who often cover repairs themselves. It's a completely different world, but one with serious opportunity for those willing to learn. The message is simple. Vanilla might be struggling, but property isn't dead. It's just demanding creativity. And here's the golden rule that overrides everything else: supply and demand. The UK is in a housing crisis. Demand for rental properties has never been higher. More people are renting for longer. Immigration, population growth, and changing lifestyles all add pressure. But supply? It's broken. House building targets are missed year after year. Local councils can't keep up. Developers are slowed down by red tape. What happens when demand skyrockets but supply stalls? Prices rise, rents rise, and those who hold property, no matter how tough the journey, benefit in the long run. That's why, despite all the doom and gloom, property remains one of the most resilient assets in the world. So here's the brutal truth. Buy-to-let isn't dead, but it has killed off the lazy landlord. The ones who thought it would always be easy, the ones who didn't bother to learn new strategies, the ones who relied on luck instead of skill. They're gone. The ones left, the ones still thriving, are the adapters. The investors who embrace limited companies, who pivot into HMOs, who experiment with serviced accommodation, who stay one step ahead of legislation. Because the truth is, property isn't simple anymore. But for those willing to adapt, the opportunities are bigger than ever. So, is buy-to-let dead? No, it's alive, but it's changed. The days of easy profits are over. The days of creative strategy, smart structuring, and adaptability are here. Yes, the barriers are higher. Yes, the rules are tougher. Yes, the profits are slimmer if you do it wrong. But demand isn't going anywhere. And that's why property investment isn't going anywhere either. So the real question isn't whether buy-to-let is dead. The real question is, are you ready to evolve with it? Because in this new era, the ones who adapt don't just survive, they dominate. The UK government is about to unleash the biggest crackdown on landlords in decades. And if you own property, or even rent, the changes could flip the housing market upside down. So why now? The Treasury is facing a £40 billion black hole in the public finances, and Chancellor Rachel Reeves is running out of options. With income tax, VAT, and employee national insurance already ruled out, the government has turned its eyes on one group they believe won't cost them many votes: landlords. Right now, most rental income is exempt from national insurance, but that loophole could soon close. The Resolution Foundation has proposed slapping a 20% NI charge on rental earnings, with an extra 8% surcharge above £50,270. For landlords, that's a nightmare. For the government, it's an easy £2.3 billion a year. Labour insiders have been clear. Property income is unearned revenue, and they're coming for it. But here's the problem. When you tax landlords, they don't just swallow the cost. They raise rents, or they sell up. And that's exactly what's already happening. Next, capital gains tax. At the moment, your main home is safe. You can sell it without paying CGT. But behind closed doors, the Treasury is reportedly looking at removing that exemption for high-value homes, possibly starting at £1.5 million. That would mean, for the first time, selling your own home could trigger a 24% tax bill if you're a higher-rate taxpayer. This would be a seismic shift. Labour swore before the last election that your primary home would never face CGT. Now, with billions on the line, that promise looks shaky. Then there's stamp duty. It raised £11.6 billion last year, but it's widely hated, seen as a killer for first-time buyers and downsizers. Reports suggest the government is seriously considering scrapping it. But here's the catch. In its place could come a new annual property tax. Homes worth over £500,000 could face a 0.54% yearly charge, with higher rates on properties over £1 million. So instead of a one-off hit when you buy, it's a permanent bill every year. Great news if you're buying cheap. Devastating if you're sitting on a London townhouse. And it doesn't stop there. Council tax is still based on property values from 1991, which means someone in London can pay the same rate as someone in the north, even though their home might be worth 10 times as much. Economists call it broken. Politicians call it unfair. And Reeves may be the one to finally press the reset button. But here's the danger. Sudden revaluation could wipe tens of thousands off house prices overnight. That's why experts warn. Reform has to be slow, phased, and cross-party. But with the budget looming, slow may not be on the table. Here's the twist. More than 1 in 8 MPs earn rental income themselves, including 43 Labour MPs and even 4 cabinet ministers. So while politicians profit from property, they're preparing to squeeze ordinary landlords harder than ever. Critics call it hypocrisy. Labour calls it fairness. The truth? It's about revenue. So what happens if these changes land all at once? Analysts say many landlords will simply sell up and leave the market. That means fewer rental properties, and fewer rentals means higher rents. Tom Bill of Knight Frank put it bluntly. When you tax an activity, you get less of it. And right now, the activity is renting out homes. Zoopla even warns that the uncertainty is already stalling the housing market. Buyers are waiting, tenants are nervous, and landlords are caught in the middle. Landlords are being painted as the villains, an easy target to plug Britain's financial hole. But the truth is, these reforms won't just hit landlords. They'll hit tenants, buyers, and sellers too. The next budget could reshape the housing market for a generation. And whether you own, rent, or dream of buying, what happens in the coming months could change your life. So, what do you think? Are these reforms long overdue? Or will they backfire and make the housing crisis even worse? Imagine this. It's 2027. You're scrolling through property listings on your phone, and there it is. The exact house you looked at just 2 years ago. Back in 2025, it was £300,000. Today, the seller wants £400,000. Same bricks, same postcode, same house. But now, you're facing an extra £100,000 price tag, or worse, you're completely priced out. This is the nightmare keeping thousands of buyers awake right now. Some believe we're in a once-in-a-decade buying window, the kind of rare opportunity that could set you up for life. Others are convinced that a historic crash is coming in 2027, and buying now would be financial suicide. So what's the truth? And more importantly, what should you do? Should you buy now, or should you wait for the crash everyone's whispering about? That's what we're going to unpack today. But before we get to the predictions, let's rewind the clock. Because what's been happening in the UK property market over the past 18 months sets the stage for everything that comes next. In 2024, I had countless investors tell me the same thing. Labour will tank the market. It's over. People were panicking. Some even rushed to sell their houses, desperate to get out before the supposed crash. But here's what actually happened. Instead of a collapse, we saw steady, healthy growth. On average, house prices rose by 4.7%. That means if you bought a £300,000 property last year, you've already banked around £14,000 in capital growth. And that doesn't even include rental income. The broader economy, stuttering along, yes. GDP growth barely scraping 0.1 to 0.5% per quarter. But confidence hasn't disappeared. In fact, the FTSE 100 jumped nearly 6% in 2024. Banks like NatWest and Barclays posted record-breaking profits, proving that there's plenty of money in circulation. Meanwhile, government policy has been reshaping the playing field. The rental reform bill is forcing landlords to adapt, while changes to the planning system promise to shake up supply. The result is a market more complex than anyone predicted. Not the crash that doomsayers were selling, but not a runaway boom either. And then came 2025, a year that, on paper, should have made buying easier than ever. Except, of course, reality wasn't that simple. The Bank of England dropped its base rate to 4.5%. In theory, this should have been fantastic news. Cheaper borrowing, lower monthly repayments. Buyers should have been celebrating, but banks weren't handing out mortgages like party favours. Instead, they got stricter. Some lenders started demanding 35% deposits. Stress tests became brutal. Rental yields were scrutinised with a magnifying glass. And in certain cases, if a property looked even slightly overpriced, banks simply refused to lend at all. Yet despite tighter lending, something else shifted. For the first time in years, buyers had leverage. Why? Because supply surged. Developers, investors and homeowners flooded the market with listings. Rightmove even reported its busiest Boxing Day ever for new properties hitting the platform. Suddenly, sellers were competing for buyers, not the other way around. Discounts, incentives, flexibility. This was what many had been waiting for. But here's the catch. Even with more choice, analysts still expect prices to rise another 3% in 2025. Not a dramatic surge, but enough to make you wonder whether waiting is really worth it. So what's really driving this? It's bigger than politics or 1 year's interest rate changes. To understand where we're heading, we need to talk about a cycle that's been repeating itself for centuries. Economist Fred Harrison is practically a legend in property circles. Why? Because he predicted the 2008 crash years before it happened. He also called the crash in 1992 and the one in 1974. How? By studying something called the 18-year property cycle, a repeating pattern that has shaped the housing market for over 300 years. Here's how it works. After every crash, the market takes about 4 years to recover. Banks start lending again, but cautiously. Confidence creeps back in. Then comes a 6 to 7 year phase of steady growth. Prices climb predictably, investors make consistent returns, and property feels safe again. But around year 9 or 10, the market wobbles. Not a full crash, just a stumble. What Harrison called the mid-cycle dip. Buyers get cautious, prices flatten, confidence shakes. Then comes the sprint. After the dip, demand surges, and prices rise aggressively. This is where greed takes over. Everyone rushes in, convinced property will only ever go up. And then, the crash. A brutal correction that wipes out years of gains in a matter of months. Sound familiar? It should. After the 2008 crash, recovery began around 2012. Growth carried through until the mid-cycle dip in 2019. Then, despite COVID, the market roared ahead in 2020-2025. If Harrison's model holds, we're now in the sprint phase, the last gasp before the fall. And if history repeats, 2027 will be the year prices tumble, possibly 20–30% in the hardest hit areas. But does that mean you should wait? Not necessarily, because it all depends on the kind of investor you are. If you're a long-term investor, timing doesn't matter nearly as much as you think. Let's say you buy in 2025 for £300,000. The crash hits in 2027 and your property's value drops 20%. On paper, you've lost £60,000. Painful, yes. But fast forward to 2035, and that same property could easily be worth £400,000 or more. Meanwhile, tenants have been covering your mortgage. Inflation has been eroding the real value of your debt. You've weathered the storm. For you, timing the market matters more than timing the market. Now flip it. If you're a short-term investor, a flipper, a speculator, timing is everything. Harrison's model suggests prices might rise another 15% before the crash. So you could, in theory, buy at £300k, sell at £345k, and pocket the difference. But here's the danger. Almost nobody gets the timing exactly right. If the crash comes earlier than you expect, you're left holding an overpriced property as demand collapses. So yes, long-term versus short-term changes everything. But either way, waiting for 2027 comes with its own hidden risks. Crashes don't just lower prices, they change the rules of the game. In a downturn, banks slam the brakes on lending. Mortgage approvals become rare. Cash buyers dominate the market, snapping up bargains while ordinary buyers are left on the sidelines. So yes, you might get that £300,000 house for £240,000 in 2027. But only if you can pay cash or somehow convince a nervous lender to take a chance on you. For most people, the opportunity of buying at the bottom never materialises. That's why waiting isn't always the safer play. Because the very moment you think you've won, the system shifts the goalposts. Now, let's be clear. The 18-year cycle has been frighteningly accurate. But cycles aren't prophecies, they're patterns, and patterns can be broken. Global shocks, wars, pandemics, energy crises, tech revolutions can all derail the timeline. Government decisions, like sudden tax reforms or emergency rate cuts, can either delay or accelerate the cycle. And sometimes, pure psychology plays the biggest role. Fear and greed move markets more than charts ever will. So yes, Harrison may be right again. But if we've learned anything over the past decade, it's that the unexpected always finds a way to show up. So how do you protect yourself? Forget obsessing over exact timing. Start with strategy. What's your goal? Is it cash flow from rentals? Long-term wealth from capital growth? A quick flip for short-term profit? What's your financial position? Do you have reserves for void periods? Enough deposit to survive stricter lending? The patience to hold for a decade if things go south? Think in decades, not months. If you're in this game for the long haul, almost every crash looks like a blip in hindsight. The people who panicked during COVID, waiting for prices to collapse, missed out on one of the fastest booms in history. Fear cost them more than any overpriced property ever could. But let's be honest, not all locations are equal. Some cities are already overvalued, with weak job markets, declining populations, or rental demand that just doesn't stack up. Buy there, and no cycle in the world will save you. In fact, there are several UK cities I would personally avoid in 2025, areas where the fundamentals are weak, and the short and long-term growth just doesn't look good. And that's exactly what I'll be breaking down in my next video. The specific cities you should steer clear of if you're serious about building wealth. So, should you buy now or wait? The truth is, there's no single right answer. If you're in it for the long term, buying now can still make sense. If you're flipping, caution is key. If you're waiting for 2027, be prepared with cash and patience. But the worst decision, doing nothing out of fear. Because while the cycle is powerful, the one thing it never forgives is hesitation. So the question isn't really, should I buy now or later? The question is, what's my strategy and am I ready to execute it? And if you want to know the UK cities that could wreck your investment in 2025, make sure you watch this video next, because knowing where not to buy is just as important as knowing where to strike. What if your kids never get to own a home, and the plan to make that happen is already in motion? That's not a headline. It's the quiet shift happening behind the scenes while most people argue about mortgage rates on social media. In the background, deep-pocketed institutions are buying whole blocks, whole developments, even whole towns. And while everyone's waiting for a perfect moment to buy, the rules of ownership are being rewritten. This isn't just a warning, it's a fork in the road. Stay a renter for life, or find the cracks in the system and slip through while you still can. But that's not the whole story, because the same conditions that lock families out can create the sharpest discounts we've seen in years. The kind of once-in-a-cycle mispricing that turns panic into profit for anyone prepared. Some say prime postcodes have fallen harder than anyone expected. Others say that's only the first domino. The questions are simple. Who's actually buying? Why now? And what does it mean for the last generation that might still own where they live? Keep watching, because by the end, you'll see exactly how the board is being set up and how to stop playing the game as a pawn. Prices don't fall evenly, they fracture. One street gets hammered, the next one holds. That's why most people miss the turn. They look at national averages and think, not in my area. Meanwhile, the data from certain pockets reads like a plot twist. Luxury districts wobble, trophy postcodes blink, properties that felt untouchable suddenly sit on the market with asking prices that would have sounded impossible 2 years ago. Sellers who laughed at low offers now take phone calls they wouldn't return last spring. And when fear shows up, narratives multiply. The headlines say, soft landing. The agents say, motivated sellers. The institutions say nothing and keep wiring money. That silence is the loudest signal. Because seasoned buyers don't react to the noise. They react to the gap between what something is worth in 10 years and what the current owner can stomach today. If you hear whispers that elite streets have shaved 30%, 40%, even more in isolated cases, that's not the market breaking, that's the market blinking. But who has the confidence to move when everyone else is frozen? That leads to the part almost nobody likes to admit. While families refresh mortgage calculators, funds and insurers are signing bulk deals. Not one flat, not two, entire phases of new builds, entire sites. It's the rise of build-to-rent, purpose-built units financed by institutions, designed not to sell but to hold for decades. No chain, no mortgage drama, no subject to valuation. Just long-term capital flowing into an asset class that historically pays out in time and tax efficiency. It isn't just global names. It's domestic lenders, insurers, pension giants with brand names you've known your entire life. They aren't just offering products, they're becoming landlords at scale. And the logic is ruthless. If they can own the stock, they can own the income. If they can own the sites, they can shape the market. For the average buyer, that means bidding against balance sheets that don't flinch when rates wobble. For renters, it means a new reality. Professionally managed buildings on professional terms. Stability on paper. Dependency in practice. The play is simple. If demand outstrips supply for years, owning the assets becomes a pension. If supply lags, rents rise. If rates fall later, the equity pops. And if rates stay sticky, they wait. That's the patience retail buyers usually can't afford. So while households debate whether now is the bottom, institutions quietly remove the bottom altogether. And that introduces the pressure you can feel, but can't always name. Affordability has a way of feeling personal, even when it's structural. You don't need a spreadsheet to know rents are eating a bigger bite of each payslip. You don't need a governor to tell you a 2-income mortgage is the new normal. What used to be comfortable on one salary now barely coasts on 2. The weekly shop creeps up. Childcare costs step in, where a second parent used to be home. The household budget starts to look like a balloon you're squeezing from both ends. The middle bulges, something's about to pop. Now, layer in the multiplier. House prices versus average earnings. A generation ago, buying meant 3 or 4 times your salary. In many areas today, it's double, triple that, without the pay rising to match. Lenders respond by favouring joint applications. 2 incomes, 2 sets of payslips, 2 people working longer hours to qualify. It's sold as inclusive underwriting. It feels like the new toll to cross the bridge. And here's the sticking point. If the base cost of a secure life is rising faster than the pay that funds it, something has to give. Time at home, savings for the future, or the dream of ownership itself. That's not a vibe, that's arithmetic. But the story isn't just about what families are losing, it's about what the big money already understands. Ask anyone who retired comfortably in the last decade where their wealth came from, and you'll hear the same answer more often than not. The house, not a tech startup, not a crypto punt. The home they bought 30 years ago and paid off slowly. The second property they rented out for a bit of extra income. The equity that swelled while life carried on. That's why institutions love residential real estate. It's a cash flow you can see, backed by a human need that doesn't go out of style. Insurers, pension funds, asset managers, they understand the quiet compounding of roofs and walls. Day 1, a rental can look modest. Year 5, rents are up. Year 10, debt has been chipped away. Year 15, the leverage ratio flips and the cash flow thickens. It's dull, which is exactly why it works. It doesn't rely on a viral moment or a moonshot exit. It relies on what people do every month, pay to live somewhere. So when you see headlines about billions funneled into residential platforms, don't read it as a corporate fad. Read it as a statement of intent. They're not betting on housing because it's cute. They're betting on it because they can model the next decade and they like the math. Which brings us to the paradox. The very forces locking people out can also unlock the best buying windows for the few who recognize them. So when you see headlines about billions funneled into residential platforms, don't read it as a corporate fad. Read it as a statement of intent. They're not betting on housing because it's cute. They're betting on it because they can model the next decade and they like the math. Which brings us to the paradox. The very forces locking people out can also unlock the best buying windows for the few who recognize them. Here's the uncomfortable bit. You won't catch the exact bottom. Nobody does. You only catch value. Properties you'd be happy to own for 15 years at prices that already look low against their rental income and replacement cost. And value tends to hide where people are most emotional. Luxury zones that felt invincible. Secondary markets with ugly headlines. Regions starved of new construction. The places where the story is loudest and the math quietly works. And if you still think this is just theory, remember what happened the last time fear seized the market. In the last big downturn, prices didn't politely shave off 10% and stop. They overshot. Banks retrenched. Sellers handed back keys. The brave looked reckless. The cautious looked wise. Then time passed. The reckless entries became the best trades of a lifetime. Properties bought at 70 turned into 200. Not overnight, not with a magic trick, with patience, rental income, and debt that got smaller relative to everything else. Recessions don't make most people rich. They scare most people to the sidelines. But they do compress future returns for those who act while everyone else freezes. The logic is brutal and simple. When assets reprice fast, the next decade's compounding comes to you in a lump. If you can stomach buying when the neighbours won't, you're getting paid for the discomfort. This isn't risk-free. Over-leverage is how good bets go bad. A thin buffer is how a smart buy becomes a fire sale. The lesson isn't buy anything. The lesson is buy right. Cash flow first. Conservative stress tests. Fix what you can control. Financing, tenant quality, maintenance discipline. Do that, and the cycle becomes your partner rather than your enemy. And once you grasp why conservative buying wins, you finally understand why the banks behave the way they do. Ask for a large loan to speculate on a coin and see how fast the answer is no. Ask for the same money secured against bricks and mortar, and the conversation changes. That's because banks understand one thing better than anyone. Homes don't vanish. People don't stop needing shelter. If a borrower falters, there's an asset to take back. It's harsh, but it's also why mortgages exist at scale while other loans get rationed. So lenders structure their world to win no matter the cycle. In good times, they collect interest. In bad times, they take back assets that others can't afford to keep, then sell them later. Heads, they win. Tails, they still often find a way to win. Does that feel unfair? Maybe. But it's also a blueprint for how to stop playing the game as a customer and start playing it as an operator. Copy the parts that work for households. Buy assets that pay you to hold them. Lock in terms you can sleep with. Assume rainy years and plan to survive them. Don't rely on guesswork about rates. Rely on margins that function if the rate picture isn't perfect. The bank's edge is structure, not swagger. Build your version at your scale. Which brings us to the only decision that actually matters. 2 paths. On the first, you wait for clarity that never arrives. Rents keep climbing, deposits keep slipping out of reach, time keeps moving. You become a permanent customer of someone else's certainty. On the second, you accept the market's messiness and go hunting for value. Boring, cash-flowing, well-bought value. You aim for one property that holds its own, then another. You stop trying to time perfection and start stacking good decisions that compound. You don't need 10 units tomorrow. You need one soundbuy in the next window that opens. You don't need to outbid a fund online. You need to negotiate like a grown-up on a deal that fits your numbers. No heroics, no lottery ticket thinking. Just ownership that is slightly underpriced today and powerfully inevitable 10 years from now. This isn't a promise that everyone can or should buy immediately. It's a reminder that the window for ordinary people to own might not stay open forever. If institutions are turning homes into yield and governments can't build fast enough, then the last generation of owners will be the ones who stopped waiting for a memo and moved before the door clicked shut. And if you're still listening, you already know which one you want to be. The ground is shifting. Big players aren't arguing about whether housing is over or done. They're buying it. They're holding it. They're building portfolios designed to outlast tempers, headlines, and cycles. For families trying to buy a first place, that can feel like a wall. But for people who learn the rules, even late, it can be a ladder. You've seen what happens when fear takes over. Markets don't just correct, they convulse. Discounts appear when nobody expects them. Narratives scream while numbers whisper. If you've ever said, "I wish I'd bought back then," this is what back then looks like in real time. Messy, uncertain, argumentative, uncomfortable. It never feels like the right moment. It only looks obvious in hindsight. So don't wait for a perfect sign. Build a plan you can fund. Target areas where rent covers your sleep. Negotiate harder than you scroll. Focus on the type of property you'd hold for 15 years without flinching. Then act once the numbers fit your life, not someone else's spreadsheet. Because one of 2 things happens from here. Either the era of mass home ownership closes and the next generation grows up renting from badges and logos, or enough people slip through the cracks now to keep the flame alive. If you do nothing, the choice is made for you. If you move carefully, you give your future a fighting chance. Remember, in a world where institutions buy certainty, your edge is speed, sanity, and the willingness to own when the crowd is louder than the math. If you don't risk a measured step, you risk drifting forever. Choose your side before someone else chooses it for you. The next video breaks down the exact deal checklist I use to separate value from noise. Income, stress tests, financing traps, and the 5 red flags that turn a bargain into a bad buy. It's short, punchy, and worth your next 5 minutes. But first, breathe, then decide which path you're on. Almost 40% of UK landlords are considering selling in 2025. That figure is staggering, nearly triple last year's numbers. But here's the twist. The headlines point to rental reforms as the culprit. But the reality is far more layered, stretching back years before the bill was even written. If you take the news at face value, you'll think landlords suddenly panicked this year. But when you look closely at the data, the policy changes, the economics, and the demographics, you see a much bigger story. The slow-motion exit of private landlords and the simultaneous rise of corporate rental giants. The big question: does this spell the end of buy-to-let for ordinary investors, or does it mark the beginning of a more professional, scaled, and ultimately more profitable era for those who adapt? A lot of people think the landlord exodus started when the government began talking about rental reforms in 2024. That's simply not true. In fact, the retreat began long before. Take Hampton's data. In 2024, landlords accounted for just around 11% of property purchases, the lowest share since records began in 2010. To put that in perspective, back in the mid-2010s, landlords were scooping up closer to 15–17% of sales. That's thousands of homes that would once have been rental stock, simply not making it into the sector anymore. The government's English Private Landlord Survey adds another layer. About 31% of landlords said they planned to reduce their holdings within 2 years. Combine that with shrinking investor share, and you see the long-term trend. A supply-side squeeze not caused by sudden panic, but by steady disincentives building year after year. This wasn't triggered by one headline. It's the story of landlords slowly exiting the stage, long before the curtain on Section 21 ever fell. And if you zoom out even further, you'll notice that this is part of a bigger cycle. UK property has gone from wide-open opportunities in the 90s and 2000s to a heavily regulated, high-barrier industry in the 2020s. The first, and most obvious factor, interest rates. 2 years ago, many landlords were sitting on mortgage deals below 3%. For decades, low rates made property feel bulletproof. Rents rose faster than costs, and refinancing was a tool for growth. But by mid-2023, the world looked different. Average buy-to-let mortgage rates surged past 7% at the peak, before settling into the 5–6% range. For anyone rolling off a fixed deal, the jump was brutal. Imagine running your numbers at 2% interest and suddenly facing repayments at 6%. That's not just a squeeze, that's a guillotine on cash flow. Now add the second punch: tax. Since Section 24 phased in from 2017 to 2020, landlords holding properties in their personal names lost the ability to fully deduct mortgage interest as an expense. Instead, they get a 20% credit, which doesn't touch higher rate tax bills. This change took time to bite, but as rates rose, the pain magnified. Suddenly, a landlord who once cleared £400 a month after costs might find themselves breaking even, or even losing money after tax. On top of that, the government increased the stamp duty surcharge on additional properties to 5% in late 2024, raising entry costs for anyone thinking of expanding. Put simply, property went from set and forget to stress and sweat. Margins thinned, voids hurt more, and landlords were forced to actually run spreadsheets. And many didn't like what they saw. Not all of this is about numbers. A major but quieter driver of landlord exits is age. The average landlord in the UK is around 60 years old. Many who piled into property during the buy-to-let boom of the 90s and early 2000s are now retiring. Hampton's reported that in 2022, 73% of landlord sales were linked to retirement. This age wave matters because it's irreversible. You can tweak mortgage rates, you can change tax law, but you can't stop people from hitting retirement age. After decades of owning, many landlords look at today's market, full of regulations, compliance checks, and rising costs, and ask themselves, do I really want this hassle in my 60s and 70s? For many, the answer is no. They cash out, bank their equity, and move on. This trend alone explains why rental supply keeps shrinking. Even if policies had stayed the same, you'd still see a steady stream of landlords exiting for good. The rental reforms might have sped things up, but the train was already rolling down the tracks. Now, Let's talk about the headline grabber, the Renters' Rights Bill. Everyone knows it ends Section 21 no-fault evictions, but that's just the tip of the iceberg. Here's the fuller picture. All tenancies become periodic, no more fixed terms. Tenants stay until they choose to leave, or until the landlord proves a legitimate reason for possession, like selling or serious breach. Rent increases limited to once per year. Landlords can't just raise rent mid-tenancy to chase inflation. And if tenants believe the increase is unfair, they can take it to a tribunal. Bidding wars banned. Landlords can't advertise a property at one price and then hold an auction among desperate renters. New property portal and ombudsman. Every landlord has to register, and disputes funnel through a national ombudsman service. Decent Homes Standard and AWAB's law extended. Landlords must meet stricter repair and safety standards, with faster timelines to resolve hazards like mould. This is not tinkering, it's a wholesale rewire of how private renting operates. For tenants, it's more security. For landlords, it's more paperwork, more compliance, and fewer shortcuts. Even before these reforms bite, landlords already face a problem that quietly kills cash flow: delays. The court system is notoriously backlogged. Median time from filing a possession claim to actually regaining control of a property is around 6 months. In reality, many landlords say it stretches to 9 months or more once bailiffs and backlogs are factored in. Now picture this. Your tenant stops paying rent in January. You file in February. By August or September, you might, if lucky, have the property back. In the meantime, your mortgage lender still expects payments, your insurance still costs money, and repairs don't pause just because rent isn't coming in. That's half a year of negative cash flow. Tribunals on rent increases have their own timelines, often dragging on for months. The irony? By the time a rent hike is approved, inflation has moved again, and you're still behind. This mismatch between rising costs and slow legal processes is what really erodes small landlords' resilience. Large corporates can absorb it. Individuals often cannot. This brings us to the other half of the story: institutional landlords. While individuals pull back, corporates are charging in. In 2023, build-to-rent investment hit about £4.6 billion. In 2024, it rose again, closer to £5.4 billion. And here's the kicker. Nearly 77% of that investment was in single-family homes, not just shiny city centre towers. This is a structural shift. For decades, private landlords dominated the suburban rental market. Now, funds and banks are muscling in. Take Lloyds Bank. Through its Lloyds Living brand, it's not only financing landlords, it's becoming one, partnering with developers to own and manage rental stock directly. Why? Because compliance-heavy, regulation-dense markets favour scale. If you can hire lawyers, asset managers, and maintenance teams, red tape becomes a moat, not a burden. Small landlords grumble at paperwork. Big corporates shrug and add another compliance officer to payroll. And just like that, what was once a cottage industry is being reshaped into something that looks much more like an infrastructure sector. You might expect that if landlords are leaving in droves, rents would skyrocket. But the data shows nuance. In 2023, rents for new lets soared nearly 9% year on year. By late 2024, that cooled to around 3–4%. Through 2025, it's eased again into the 2–3% range. That doesn't mean renting got cheaper. It means the growth slowed, but it slowed on top of record high levels. More than half of all private rentals in the UK now sit above £1,000 a month. And with wages under pressure, affordability is stretched. For landlords who stay, this is a double-edged sword. On the one hand, demand is still high. UK population growth and limited supply guarantee that. On the other hand, tenants are hitting affordability ceilings. Push too far on rent, and you risk voids, arrears, or tribunal challenges. The easy years of jacking up rents without question are over. Professional landlords will price carefully, justify with comparables, and manage longer-term tenancy value. Amateurs will chase short-term gains and stumble into disputes. Here's the honest answer. Buy to let as a hobby is dead. If your plan was to buy one flat and hope it pays for a couple of holidays each year, 2025 is going to chew you up. The rules, the costs, the risks, they don't reward casual involvement anymore. But if you treat property like a business, the opportunity is still very real. That means choosing the right structure, company versus personal, running your numbers at today's interest rates plus a stress buffer, building cash reserves for voids and court delays, leveraging TLC margin, buying tired stock that retirees are offloading and adding value through refurbishment, scaling to at least 3-4 properties where professional management and systems become viable, avoiding areas where institutional investors dominate and instead fishing in markets they overlook. Do these things and you're not playing the old game anymore, you're playing a new one. One that looks less like speculation and more like professional asset management. Here's the part. The headlines don't tell you. Exits create opportunities. As older landlords sell, often in need of quick cash or relief from hassle, deals emerge. Many of these properties already have tenants in situ, which means you start earning from day one. Others need refurbishment, giving you a chance to capture uplift and reposition at higher rental yields. And think about this. When institutions like Lloyds and global funds are piling billions into UK rentals, they're not guessing. They have research teams, demographic data, and long horizons. If they believe rental housing in Britain is a 10-20-year growth story, maybe the question isn't, is buy-to-let dead? But, are you prepared to play by the new rules? Because in the end, property isn't disappearing, demand isn't falling. What's disappearing is the casual landlord model. What's emerging is a world where compliance and professionalism are rewarded and shortcuts are punished. So is 2025 the end for landlords? Only if you refuse to adapt. For those who treat property like a serious business, it may be one of the best years to buy in over a decade, with distressed sales, tenant demand, and institutions validating the market. In the next video, I'll break down exactly how to buy and rent property in 2025 without tripping legal wires or bleeding cash flow. The structures, the numbers, and the compliance checklist you need to survive. Click through now, because in this new landscape, mistakes are more expensive than ever. But opportunities are too. The UK housing market is collapsing under the weight of its own contradictions. On one hand, buyers are locked out of homes they've already paid for, waiting months, sometimes over a year, just to be allowed inside. On the other, entire streets sit abandoned, windows boarded, weeds growing through cracked concrete, while thousands of families wait on social housing lists and thousands more live in temporary accommodation. It feels like a cruel joke. We have houses, but people can't live in them. For decades, politicians promised solutions. They told us home ownership was the dream, the reward for hard work. They swore that building more homes would fix the problem. But what's unfolded instead is a nightmare of bureaucracy, financial traps, and political theatre. Regulators block finished properties, councils profit from empties, and developers drown in paperwork while families drown in debt. So the question is simple. How did Britain, once a nation where owning a home defined success and stability, end up in this chaos? And the harder question, what comes next? It all begins with the very institution designed to keep us safe, the Building Safety Regulator. After the Grenfell tragedy, which claimed 72 lives and scarred the nation, no one doubted the need for stricter oversight. The government created a regulator to ensure that buildings met higher standards, that corners weren't cut, that safety was finally placed above profit. On paper, it was a noble mission. In practice, it has become a chokehold on the entire housing system. As of this year, 1,210 brand new homes, fully built, ready for residents, are sitting empty. Why? Because the regulator hasn't signed them off. Families who poured savings into deposits are trapped in limbo, paying rent elsewhere, watching their money vanish while their homes sit gathering dust. Developers, meanwhile, are losing fortunes. Some report bleeding £100,000 a week on projects stalled for months on end. And the reasons for delay? almost laughable if they weren't so devastating. Sky News revealed one case where an entire block of flats in Acton was left vacant for over 14 months because the signs inside were 2 mm too small. Every single sign had to be remade and replaced before approval could be granted. Bureaucracy taken to the extreme. Developers argue that the system is not fit for purpose. They claim the regulator moves at a snail's pace, provides little guidance, and sometimes rejects paperwork over technicalities it never bothered to explain. The regulator blames developers in return, saying they fail to submit the right documents. Meanwhile, ordinary people, the ones waiting to move in, are caught in the middle. The irony is cruel. A regulator designed to prevent another Grenfell is now holding up safer buildings, forcing companies to abandon projects and driving up costs across the sector. And those costs inevitably land on buyers and renters. The very system built to protect people may now be pricing them out, but this is only the first twist in a much bigger disaster. If the regulator delays feel absurd, the next problem borders on surreal. Across England, nearly 720,000 homes are empty. Yes, while millions struggle to rent or buy, 750,000 properties are sitting idle. Of those, about 265,000 are long-term empty, meaning no one has lived in them for over 6 months. And here's where the contradiction gets painful. Right now, over 354,000 people are homeless in England, and 1.3 million households are waiting for social housing. Families are packed into temporary B&Bs, young professionals are stuck in flat shares into their 30s, and yet vast swathes of housing stand unused. Why? Some of these homes are derelict, falling apart, with owners who can't or won't invest in fixing them. Others are caught in probate, locked in legal limbo after someone dies. Some are owned by investors who are simply sitting on them, waiting for values to rise. And some councils quietly prefer them empty because long-term vacancies are taxed at a premium, up to 300% of the usual rate. In other words, the worse the problem gets, the more councils make from it. There are schemes to tackle this. In Lewisham, for example, the council offers up to £20,000 to refurbish derelict homes. Across Kent, the No Use Empty scheme provides interest-free loans for owners willing to rent or sell. But uptake is dismal. In Lewisham, despite more than 2,200 empty homes, only 22 grants were awarded in 5 years. And even when councils do act, the numbers barely scratch the surface. The result? A surreal contradiction where empty homes drag down neighbourhoods, attracting crime and vandalism, while thousands of families remain desperate for shelter. It's not just inefficient, it's immoral. But even if every empty property was filled tomorrow, the bigger problem would remain. Homes are simply unaffordable for the majority of people. Back in the 1980s, you could buy a Victorian house in South London for £24,000. One woman did exactly that, using a council grant to fix the ceiling. Today, that very same home is worth £1 million. In one lifetime, a property went from affordable to impossible. And that's the heart of the affordability trap. For most young workers, home ownership isn't even a dream anymore. It's a fantasy. The average house now costs more than 9 times the average salary, when affordability is usually defined as 5 times. Deposits stretch into tens of thousands, with banks rejecting applicants under strict affordability rules. Parents are often the only route onto the ladder. Without their help, many are permanently locked out. Renting isn't a solution either. Landlords charge record-high rents for increasingly poor-quality homes. Tenants find themselves paying half or more of their monthly income just to live in places plagued by damp, mould and disrepair. Saving for a deposit becomes impossible when rent drains every spare pound. Politicians and media often point the finger at immigration, claiming demand from newcomers has pushed locals out. But the deeper truth is decades of poor policy. Right-to-buy schemes sold off millions of council homes without replacing them. Investment in social housing stalled, and financial systems have been tilted towards investors, second home buyers, and overseas capital, all while wages stagnated. The outcome is a generation trapped between unaffordable mortgages and unlivable rents. And while ordinary people are told to work harder or move somewhere cheaper, politicians keep dangling promises that never seem to materialize. Every election cycle, housing becomes the headline promise. We'll fix the market, they say. We'll build more homes. The latest slogan from Labour is Build Baby Build, a pledge to create 1.5 million new homes this Parliament. But look closely, and the math doesn't add up. Developers are already warning they can't deliver, not with today's regulatory delays, skyrocketing material costs, and endless planning backlogs. One managing director admitted his projects were running 6 to 12 months behind, with millions locked in limbo. Others have walked away altogether, saying projects are no longer financially viable. And yet, there's no shortage of money. Investors are lining up with capital, ready to finance construction through bonds, mortgages, and hybrid funds. The problem isn't funding, it's bureaucracy. Every level of the system, from local planning committees to national regulators, slows things to a crawl. Even when land is available, red tape buries projects. So what happens instead? Politicians keep announcing targets. Ministers cut ribbons on half-finished projects. Housing becomes a photo op, not a reality. Meanwhile, the gap between promises and outcomes widens. And for those trying to rent or buy, the effect is devastating. Trust in both the market and the government erodes. But the real story of housing chaos isn't just about paperwork and promises. It's about the human consequences playing out in every community across the country. Housing chaos isn't abstract. It's changing daily life. In Bristol, one long empty property became a magnet for drug use and crime. Neighbours reported feeling unsafe walking home at night, and local house values slumped. Multiply that by hundreds of thousands of properties across the country, and you get entire communities blighted by neglect. The generational divide is just as stark. Parents who bought in the 80s and 90s now sit on homes worth hundreds of thousands, or millions, while their children remain lifelong renters. Wealth isn't just inherited in cash, it's embedded in bricks and mortar. One generation lives off capital gains, another drowns in rent. The resentment is palpable. Homelessness, too, is rising. Families squeezed into B&Bs, children growing up without stability, workers commuting long distances because they can't afford to live near their jobs. Cities like London, which should be engines of opportunity, are instead becoming zones of exclusion. And when housing becomes unattainable, everything else, family, careers, stability, starts to collapse with it. This isn't just about money. It's about dignity, safety, and the social fabric of the country. A broken housing system creates broken communities, and unless something changes, the fractures will only deepen. The UK housing market isn't just failing. It's failing on every level, in every direction. Regulators designed to protect buyers are stalling projects. Councils are letting homes rot while profiting from vacancy taxes. Developers are tied up in red tape. Politicians shout slogans but deliver little. And ordinary people, whether they're renters, buyers, or homeless, are left paying the price. The bigger picture is bleak. Strong nations depend on strong cities, and strong cities depend on affordable, livable homes. Without them, inequality grows, resentment festers, and opportunity shrinks. Housing is not just an economic issue, it's the foundation of a stable society. And right now, that foundation is crumbling. The question is no longer if the housing market will change. It must. The real question is how much chaos it will unleash before it does. Will we see bold reforms, councils forced to act, regulators streamlined, and genuine affordable housing built at scale? Or will Britain continue to stumble down this path of rising prices, rising anger, and rising inequality? One thing is certain: the longer we delay fixing the problem, the harder the crash will be. And when it comes, it won't just be the housing market that suffers. It will be the entire country.